Hey everyone, Karan here from Life Accounting, where we help you save on taxes and increase your wealth. And in this video, I'm going to show you how to get the biggest tax refund legally. There's only a few ways to do it, so stay tuned. Okay, so how exactly do you get the biggest tax refund possible? Well, the first thing you need to do is maximize your filing status. The filing status that you choose when you file your taxes can greatly impact how big your tax refund actually is. And unfortunately, many people fail to optimize their choice. There are 5 filing statuses: single, head of household, married filing separately, married filing jointly, and qualified widow or widower. And each status has a different standard deduction and eligibility for certain tax credits and tax deductions. Most simply choose what is obvious, right? If married, they choose married filing jointly. If single, they choose single. But if you want the biggest tax refund possible, you may need to be a bit more strategic. And here are just 3 examples where this makes sense. Example 1, a couple may want to file separately if one spouse earns a lot less and also has a considerable amount of unreimbursed medical expenses. This would allow the lower earning spouse to deduct more medical expenses than if they filed jointly. How about example number 2? Where a single parent may want to file as a head of household instead of single if they have 1 or more children living with them at least 6 months out of the year. By doing so, they can take a larger standard deduction than if they filed single. Which leads us to example number 3 of someone who financially takes care of a relative or parent who lived with them for at least half of the year. They would want to claim head of household. And once again, by doing so, you can take a standard deduction that is $6,000 larger when compared to someone who filed as single. So be sure to spend some time with your CPA to figure out what tax status may lead to the biggest refund or even a lower tax liability. All right, the second way is to claim all children, friends, or relatives that you are supporting. Most know that the ability to claim a child can help you save a ton on taxes, resulting in a massive refund. But what most don't know is that you can claim more than just your kids as a dependent based on how the IRS defines a dependent. Yes, according to the IRS, a dependent is someone you support, and at least half of their support, like food, shelter, and clothing, is provided by you. And with that said, a dependent can be any of the following: your child, stepchild, foster child, or grandchild, including adopted children, your in-laws, your siblings, including half-siblings and step-siblings, your parent, including step-parents but not foster parents, your grandparent or great-grandparents, your niece or nephew, including those of your half-siblings, your aunt or your uncle, and get this, even your boyfriend or girlfriend. Now, there are a few tests that must be passed to claim dependents, so be sure to check out my complete overview of claiming dependents, including your boyfriend or girlfriend, after you finish this video. The third way is to claim all eligible tax credits. Tax credits help you get a bigger tax refund by reducing the amount of taxes you owe on a dollar-for-dollar basis. For example, if you claim tax credits worth $3,000, your tax burden gets reduced by exactly $3,000. Now, icing on the cake comes in the form of refundable tax credits that can be claimed even if you don't have to pay taxes at all. So here are the most common tax credits. The Earned Income Tax Credit is refundable and provides a tax credit ranging over $1,500 to over $6,000 depending on your tax filing status, income, and how many children you have. The Child Independent Tax Credit provides a 50% credit up to $8,000 in qualified expenses for 1 child or up to $16,000 for 2 or more children. And speaking of children, there's the Child Tax Credit that can earn you a $3,600 credit per child under age 6 and $3,000 per child for ages 6 to 17. And the American Opportunity Tax Credit allows you to get a maximum annual credit of $2,500 if you paid for qualified higher education expenses. Like the tax credits mentioned, how much of a credit you are eligible for will depend on your tax filing status, income, and in some cases, how many children you have. For more information on tax credits that can help you get a bigger refund, be sure to watch my video on this channel on the top tax credits literally for everyone. Alright, the fourth way to get the biggest tax refund is to consider itemizing instead of taking the standard deduction. When filing taxes, most people opt for the standard deduction, which was nearly doubled for 2018 through 2025. But there are some people who would actually benefit from itemizing instead because their itemized deductions exceed the standard deduction. The most common itemized deductions that you can claim include the following: self-employment expenses, certain education expenses, certain medical expenses, charitable contributions, and mortgage interest. So be sure to check with your CPA to see if your itemized tax deductions exceed the standard deduction. Alright, but what if you can't itemize? Well, the fifth way is to claim deductions without itemizing. You see, itemizing isn't the only way to use deductions to reduce your taxable income. There are a few deductions known as above the line deductions that you may be eligible to claim even if you don't itemize. They include but are not limited to the following: contributions to an HSA account, which can help you deduct up to $3,600 in 2021 and $3,650 in 2022 for single filers, and go ahead and double that for those with family coverage. Then you have contributions to an IRA that can earn you a deduction if the total contributions you make each year to all of your traditional IRAs and Roth IRAs are more than $6,000 if under the age of 49 and $7,000 if age 50 or older, or no more than your taxable compensation for that year. Then there's interest paid on student loans that can earn you a deduction up to $2,500 depending on your income. And then we have self-employment retirement contributions that can provide a deduction for employers up to 25% of an employee's salary up to $58,000 for 2021 or up to $61,000 in 2022. And don't forget that you can even deduct your own salary reduction contributions if you are a sole proprietor or partner of a business. Okay, now I want to help you get your refund faster. If you don't know, the IRS is currently backlogged by millions of refunds, but you can help them help you to get your refund faster by doing the following. Avoid making errors on your return. Be sure your bank account matches what you put on your return. Protect yourself from identity theft. Include all income in your return. Correctly claim your dependents and file electronically, because filing by mail is literally the fastest way to delay your tax refund. I'm going to place a few videos on the screen I think you should watch next. Be sure to check them out. Also, if you found this video helpful, do me a favor and hit the like button for me. It helps others to find this video on YouTube. And subscribe to the channel for more information that helps you save on taxes and increase your wealth. I'm Karan from Life Accounting, and I'll see you in the next video.